Greetings, traders, and welcome back to our Forex mentorship program for beginners. Today, we are going to be looking at the types of orders. In the foreign exchange market or in the financial world, an order simply means a command to enter or exit a trade. There are a set of instructions that you will give to your broker to perform a certain task. If those instructions or specifications are met, your broker is going to execute your order. If you want to buy or sell a currency pair, you are going to give an order to your broker to perform this task, and your broker is going to do it if your specifications are correct. There are two major types of orders in the trading industry. We have the market order and we have the pending order. A market order is simply an order when you instantly want to execute a price. You want your broker to execute a price instantly. For example, if you stepped into the market and you wanted to buy gold, you go into your broker and you tell your broker, I want to buy this gold like now, at this particular price. If you step into the market now and you want to buy gold, you are buying gold at 250.00. So you are going to send that command to your broker and your broker will execute that command instantly. We call it instant execution. You want it to be done immediately, so it is an instant execution. That is what we call a market order. There are two types, like we said. We are going to look at the order type. The second type is the pending order. A pending order is simply an order to be executed at a later time. You get it? Like if you step in the market and you want to buy, example again, gold. You go into the market and you look at the price. What is the price at which I can buy gold now? The price is 251.00. If you press this button, gold or this order will be executed immediately. But let us say you are busy and you are not going to have time to come back to the market to buy or to sell, and you decide, I know for sure, or based on my analysis, I am anticipating that gold is going to get to a level. But if it gets to that level, I am not going to be in the market. So I am going to set a pending order. Anytime gold gets there, let my broker fill me in. Let my broker fill my order. So you have set an order before time. You have set an order that is going to be executed at a later time. It is not instant. It is not immediate. It is something that is going to happen later. That is called a pending order. There are two types of order. There is an instant execution or a market order, and there's a pending order. A pending order is when you don't take a trade instantly. It's when you place a trade before that trade plays out. But an instant execution is when you take the trade immediately. If you step into the market and you see the price of gold now, you want to sell gold at that price, 250, 2050.00. You want to sell gold immediately. You don't want to wait. If you want to buy gold now, you want to buy gold at 251.00. You don't want to wait. That is an instant execution. But for a pending order, you place a trade before it happens, ahead of time. That is the difference, please. Let us look at the types of pending orders. We have four categories, okay? We are going to talk about them. We have the buy limit order and we have the sell limit order. We also have the buy stop order and we have the sell stop order. Let us look at it again. Let's go to our picture. A buy limit order is an order where you place a trade. For example, if you anticipate that gold is going to drop, you think that gold is going to drop and come down here to this level, 2017.84. You believe that gold is going to come to this level, but you are not going to be in the market. Maybe you are busy, you are doing something. What you are going to do is, and you believe that when gold comes here, gold is going to react here and then buy. That is your anticipation based on your analysis. So what you do is you come down here and you set a buy limit order, and you believe that gold is going to come down here and it's going to bounce off this level based on your analysis. If eventually gold comes down here, the price drops, comes here and triggers you, then you were right. You set a pending order, which was a buy limit. So a buy limit is a order that is below the current market price. Understand it. Remember, this is the current market price here. Your buy limit order should be below the current market price. I hope that is understood. Now, the second type is the sell limit order. The sell limit order occurs when you believe that gold is going to push up to a certain level. You are not taking the trade immediately. It is a pending order. You believe that gold is going to push up to 2057.04, but you don't want to take a trade now. What you do is you are going to set a pending order here, which is a sell limit. This sell limit means that you are anticipating that when gold gets to this level, it is going to bounce off this level and then sell off. So you place your sell limit order here and then you leave. If the market if gold actually rises and gets to that level and triggers you, then you are right, and it begins to sell, you are right, you are going to make profit. So you believe that you are not going to be in the market, and you believe that gold is going to bounce off a certain level, and you set your order there. So sell limit orders are always placed above the current market price. Don't get confused. Buy limit orders are placed below the current market price, and sell limit orders are placed above the current market price. I hope that is understood. Now, the other category is the buy stop and the sell stop. Let's look at what the buy stop means or the sell stop means. Good. Let us assume that you think gold is going to drop down here. What you do is you come here and you set a sell stop order, because you believe that when gold comes to this level, it is going to continue to drop. So you place a trade here, you go into your broker and you say, anytime price gets to this level, fill me in, get me into the market. So if eventually gold starts dropping and triggers you, then you were right. So a sell stop order is an order that is set when you believe that price is going to sell and is going to continue to sell. And the sell stop order is always placed below the current market price. I hope that is understood. So that is an order that you set before it actually happens. So it is pending. It is not instant. Let us look at the other category, which is a buy stop order. Let us assume that you came into the market. You came into the market and you believed that gold was going to buy off from here and continue. So based on your analysis, you think that you are going to be busy and you are not going to be looking at the chart. You come to this level, which is 2022.74, and you set your buy stop order. So you are anticipating that even though price is currently below here, but you believe that when price gets to this 2022.74, it is going to continue up. So you set your order above the current market price. A buy stop order is set above the current market price. A sell stop order is set below the current market price. And if you set this order and eventually you get filled, then you were right and you are going to make a profit. So we have talked about two types of orders, major types of orders. If you step into the market now, and you want to execute an instant price action or an instant order, you will buy gold at 2051.00 instantly. That's an instant execution. But if you think that you are going to be busy and you want to place a trade and walk away, there are 4 categories that fall under the pending order. We have the buy limit. The buy limit is an order you believe that price is going to bounce off a particular level. If you believe that price is going to drop here and bounce off a particular level, 2022.74, you set your buy limit here. Your buy limit order is set below the current market price. If price gets there and actually reacts and bounces, then you were right, you are going to make a profit. On the other hand, a sell limit order is placed when you believe that price is going to push up and react at a particular level. A sell limit order is often placed above the current market price. If you believe that price is going to react at 2057.04, you set your sell limit order here. If price actually pushes up to 2057.04 and react, then you are right. The other category is the buy stop and the sell stop. If you believe that price is going to continuously moving up after a level, you set your buy stop order here. Let us say 2017.84. If price is currently down here and you believe that price is going to continuously moving up when it gets to 2017.84, you set your buy stop order here. If price actually gets there and continue moving up, then you were right. You are going to make a profit. So a buy stop order is set above the current market price. So those are the 4 categories of market orders. They fall under 2. We have the instant execution and we have the pending order. The pending order has 4 major types, which is the buy limit, the sell limit, the buy stop, and the sell stop. I hope this is clear. So if we look at an example here, a buy limit order is placed below price, and price then goes up. You have talked about that. You believe that price is going to bounce off a certain level and you place an order. If price actually bounces off that level and goes up, then you were right. That's a buy limit. A sell limit is placed where you believe that price is going to bounce above a current market price. So if price actually bounces above that current market price, then you were right. It's going to sell off. On the other hand, we have the sell stop, the buy stop. The buy stop is believed that price is going to go to a certain level and continues going up. So if you set your order above the current market price and price actually goes up above that market price, then you were right, you are going to make a profit. A sell stop order, on the other hand, is believed that price is going to continuously going down. If price gets to that level and continues to go down, then you were right, that's a sell stop order. I hope this is clear. A stop loss order. A stop loss order is simply an order you place if you believe that price is going to get to a certain level and you are going to be wrong. You set a sell stop order. Let me show you something. Now if you place a buy here, or let's say if you place a sell here, you anticipate that price is going to go down. Price will go down here, but at the same time you think that if price doesn't go down here and continues to go up, you want to be stopped out, okay? Because you don't know, price may continue to go up. You are anticipating that price is going to sell off, but we don't know, the market is funny. You may be wrong and price will continue to go up. So you want to be stopped out so that you don't lose a lot of money. So this order that you place here is a stop out order, a stop loss. Remember when we talked about the common mistakes that beginner traders make, we say do not override your stop losses. This is what we are talking about. It means in case I am wrong, stop me. When you are selling and you place a stop loss, this is considered a buy stop. It's going to be confusing for now, but don't worry. When we start trading, you understand this. On the other hand, if you are buying and you set a stop loss below here, this stop loss is considered a sell stop. Even though you are buying, your stop loss is below here, but it's considered a sell stop. If you are selling and your stop loss is below here, it is considered a buy stop. Do not worry. Those who are going to do Simon money concept with us, you are going to understand what I am talking about better. I am sure that you have been able to understand the different types of orders. If you have any questions, always feel free to ask in our mentorship group and you are going to get responded. Thank you so much for listening, and I'll talk to you later. Goodbye.